My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, then please consider liking this video and subscribing to the channel. Today, I'm going to be talking for the second time about Corteva Inc., ticker CTVA. Covered this company a few months back and also wrote an article about it here on Seeking Alpha where uh, this is early January here. Um, at the time, I was exploring ways to deliver a macro framework to my portfolio that would insulate it somewhat from inflationary sources. What I did notice is in the supply shock driven inflation wave of 2021, 2022, that agricultural input producers ended up doing exceptionally well in that environment. That led me to covering two companies. One was Nutrien, the Canadian based potash producer, and Corteva, which is an American agriscience company. If you haven't watched my initial video about Corteva, then I welcome you to do so. It'll in that video, I cover a lot more of the high level context and background of the company. So for the purposes of this video, I'm going to assume viewers have context about the company and understand what it does. What I wanted to discuss today was how the events of the last few weeks pertaining to tariffs have caused me to make some changes in my outlook for the year. And recently, I've increased my exposure to some uh, bets that I think are more oriented around a inflationary environment driven by tariffs. Now, I did make a video right after Liberation Day. It was either the day after or 2 days after, where I discussed how the market reaction to tariffs was deflationary. And there are deflationary impacts from tariffs in that they take products off of the market completely. We're seeing reports. I'm on X. I'm reading about folks that have a business importing goods from China and using them as a part of their production process, or selling them. And because of the duties imposed on those products, some of these companies are completely discontinuing their sales built around these Chinese inputs. So that takes goods and currency out of circulation in a way, if you think about it, which is somewhat deflationary. We saw how the price of oil dropped by roughly $12 a barrel on the tariff news. That is a strong deflationary signal. However, what I believe is happening is that just like in 2021, 2022, you had this supply shock driven inflation. And there was a lot of bottleneck in terms of supply chains. And I do believe that the tariff impacts are strong enough to bottleneck supply chains again. I don't know exactly where that's going to end up, but I think it is reasonable to expect that. I think it's reasonable to calculate and assign a probability that certain commodities might uh, really increase in price significantly temporarily due to supply constraints. The example that I've been thinking of in my head. Last night, my wife and I were discussing over dinner the tariffs, everything, and she said that she saw a picture on X where in a grocery store there were there were Canadian strawberries and strawberries from the U.S. and the Canadian strawberries were $5 for this little container, and the United States strawberries were $1.50. So think about that for a second. Where my mind went was, if for a particular good in the store, let's say that there's 10 sources of that good. It's a commodity like strawberries. There's 10 sources of that good. And let's just assume that 9 out of those 10 sources are external to the United States and therefore subject to import duties or tariffs. And let's just assume that those tariffs are 100%. If 9 out of 10 of the options at the grocery store have doubled the input cost, or cost twice as much for the retailer to stock them, then what ends up happening is they essentially don't stock them. Either they do stock them and they're at an absurdly high price, or they don't stock them and instead they go and they purchase more strawberries grown in the United States. Well, the impact of that is that there's much less supply after the fact of the strawberries grown in the United States because there's only so many strawberries. So what that ends up happening is it pushes up the price of the United States strawberries in the short term, at least. So while that may or may not apply to what we're discussing today, I think what we need to be cognizant of is the fact that the last inflation shock we had was very supply driven, and tariffs, given that they are so disruptive to supply chains, that they may also end up being very inflationary. So that leads us back to Corteva. Please watch my initial video on this. It'll give you a little bit more context to the company. And be sure to sign up for Seeking Alpha Premium if you don't already, and read through my analysis here. That also mirrors a lot of the things I discuss in the video, but to a little bit more specific in the points and information, because I'm sure you can imagine when I get on these videos and talk, I tend to ramble. But on January 10th, I graded the stock a buy. Since then, we've had a total return almost of 5% versus a 9% drawdown in the S&P 500. So we've outperformed the market by 15 points here on this name. And I believe that trend might continue here into 2025. And here's why. So less than a month after I performed this analysis, we had quarterly earnings released on February 6th. So this is their fourth quarter 2024 earnings, but also fiscal year 2024. So I just want to run through this, and then I want to, give my thoughts on how this year might shape up to be a meaningful year for this company. So just a couple of high level notes. So they achieved 20% operating EBITDA margin for the first time. As we see here, this has been a margin expansion story. We discussed how and why Corteva has a moat, particularly around their seed portfolio. And that's really the focus of today. So very, very strong margin expansion that is indicative of an economic moat. Here, they generated a free cash flow of $1.7 billion, which, if we look at the current market cap of 40 billion, that's like 4 something percent, less than 5%, right? So just a shade above 4%. So as we discussed in the last video, this is not a cheap stock by any means. It has strong premium pricing, which stocks that have strong moats tend to. But of that 1.7 billion, they returned 1.5 billion to shareholders via dividends and share buybacks. So just a couple footnotes here on global demand. Record-setting global consumption of corn, soybeans, and wheat in 2024. On-farm demand remains steady while grain prices are recovering from a huge cyclical upswing in the supply shock, right? So prices were like this, and then they went like this, and now they've kind of leveled out. Farmers prioritizing top-tier seed tech while managing tighter margins. Of course, the proprietary seeds that Corteva creates and sells are specific to the geographies that they sell the products, which is globally, and they, in theory, help farmers achieve better yields due to their resistance to certain diseases and climate patterns. So the seed portfolio is ultimately why I'm bullish on the company. They also have a crop protection or pesticide and herbicide business, which represents roughly half of revenue. We'll discuss that as well. So for the fiscal year 2025, they're guiding to a 10% growth in EBITDA. Also continued margin expansion, at least EBITDA margin, and planning another 1 billion in buybacks, which again represents about 2.5% of the current market cap. Okay, so this isn't like Jackson Financial that we covered the other day, but that's a very, very strong level of share buybacks. So in 2024, mixed ag fundamentals. That is certainly true. Agriculture was a bit challenged last year, and market challenges in crop protection. We saw that bear out in the stock price of FMC. FMC, of course, dropped like 50 or 60%. Due to really, really poor guidance. They're a pure play crop protection, whereas Corteva is half and half. Crop protection for Corteva has been a bright spot in this earnings report. But yes, 2024 was a challenging year for crop protection, and we saw that reflected in the stock price of FMC and to a lesser extent, Corteva. So the 2025 expectations are improving agricultural fundamentals, more corn acres, earnings improvement. They say crop protection market flat, pricing stabilizing. That the tariffs are going to completely destroy that guidance, in my view. Pricing will not be stable if there's a 245% tariff on Chinese imports, and we'll discuss why. They also discuss cost deflation. Again, tariffs do impact that somewhat, but yeah, we'll get back to that. So, what I want to discuss here, they saw a 7% increase in net sales for the quarter. Over the, I believe that's growth rates versus prior year. And then for the full year, there was a slight decline in revenue. We know that the balance sheet of this company is very cash rich, and that really does not change their capital allocation strategy whatsoever. Organic sales, very strong quarter, and for the year was pretty flat. Operating EBITDA, again, very strong in the historically weak fourth quarter, and operating EBITDA was roughly the same. And then we see very, very strong improvement in operating margins. And yeah, understatement to say mixed market conditions. So if we look at the full year operating EBITDA here, we see 86 million in currency headwinds. One thing that I've alluded to or mentioned outright is that the announcement of the tariffs the last few weeks has depreciated the dollar by several points. And while I don't find that alarming, because currencies will regularly fluctuate like that, I do believe that we're kind of seeing a reversal of the environment we saw last year, where last year what we saw was that the dollar was very strong. And so companies like this that have their earnings in dollars, or their reportable earnings in dollars, but a substantial amount of their revenues in other currencies, had currency headwinds. And I think what we're seeing and what we will see, maybe not as much in the first quarter of 2025, but definitely in the second quarter, if the current trajectory we're on continues, I believe that second quarter numbers will be a big boost to other companies, that I've covered, like Philip Morris International, which have a majority of their sales in across the world. They have a lot of sales in euros. Euros have appreciated significantly versus the dollar in recent weeks. That'll be a strong tailwind to earnings. And I think what what we see here is that this company, I do believe, is also a candidate for a company that will benefit significantly from currency tailwinds. Again, we see here in terms of EBITDA, we do see that there were gains in every single way. So they actually are projecting a currency headwind for the year. And again, this earnings report was prior to the Liberation Day tariff announcement, which I think a lot of corporate managers were not anticipating the dollar to weaken the degree that it did. So I would expect there to actually be some fluff in these numbers and this number ends up either being significantly smaller or not read at all for the year ahead. But I don't know if we have in this deck the actual amount of currency exposure, but we do kind of have it here. What they're saying for fiscal year 2025 is that pricing will be better, volume will be better, they'll have lower costs, and the dollar will be strong. But in spite of all that, they will deliver, roughly 10 to 15% EBITDA growth. Very strong numbers if they do hit them. I think what we need to talk about is how tariffs impact that, which we will in a moment. But again, just to further reiterate what I was just discussing, here we have key sensitivities. And while they do not say that these are in descending order from most impactful to least impactful, I think it might be reasonable to infer that they might. So what they're saying is what could produce downside to these numbers, or really how we get to here versus here, is a stronger dollar, lower areas planted, lower crop protection market growth, less demand for new products and biologicals, and uncertainty around impacts from trade policy. I think this is definitely happening, right? This is definitely happening. So I think that we need to, put our estimates through a lens of skepticism there. But I do believe that for the year, or for a significant portion of the year, that the dollar will be meaningfully weaker than it was last year. And that would be, as we see here, they acknowledge that a weakening dollar is a tailwind to their profits. So let's talk about seed performance. About half of the business, a little less than half, is seeds. These are seeds that they are either genetically modifying or modifying with a non-genetic process to make them more resilient to disease. But ultimately, what they are seeds. If you are a corn farmer, you're buying your seeds from somewhere, and soybeans, oil seeds, and the like. So for the entire year, almost 3/4 of the seed portfolio is corn. So what does that say? It means that if corn prices double and this company is able to maintain their margins, their profits double on that as a tailwind. Now, of course, there's some cyclicality to that, so it's not forever, really. It's reasonable to expect that corn prices come back down to earth. What we discussed was because they're branded seeds and more resilient to the location-specific weather patterns, climates, and challenges of that area, as growing conditions and the like. The company does have pricing power over more generic seed brands. So yes, I think it's reasonable to assume that when corn prices go up, that we, for the most part, maintain margins and profit if we are this company. So when there's broad-based agricultural input inflation, this company will profit. So a majority of the seeds are corn. The next biggest is soybeans. And we see here that borne out in geography. We see here how sales, the difference between reported and organic. I believe that organic is basically just before accounting for currency. Reported is currency neutral, and feel free to check me on that. Um, but we see here across all of the non-North American geographies, currency was a headwind, and so our reported numbers were lower than our organic numbers, right? But we see here that the majority of the sales are in North America, and these seeds are produced domestically to the geography they're sold in. So um, the seeds that are sold in Latin America are produced there. Again, when we say produced, right, they're seeds. They're not being put together in a factory. The seed portfolio is not subject to any sort of tariff risks because the product is originating in the geography. They're growing plants, they're harvesting seeds, selling those, rinse and repeat, right? So that's how they're doing what they're doing. The majority of that is North America. So we're insulated from tariffs here. And the only thing that we're really worried about is currency and, of course, volumes, supply and demand. But currency, again, I expect to be a tailwind. Pretty good looking numbers here. This is the kicker here. So crop protection, of course, herbicides, insecticides, fungicides, biologicals are kind of the more natural element of that. Now, crop protection had a much stronger year. Had a much stronger year. This is for the year here. We see that crop protection was challenged. Volumes went up by 3%, but prices came down. Now we know that crop protection is a little bit more commoditized and therefore more competitive, more subject to price variabilities there. So crop protection also, I wanted to take this time to highlight tariff risks. This analyst from KeyBank here asked a question. This is Ryan on for Alexi. I mean, I understand you guys didn't bake in anything to the guidance based on what's been going on with tariffs, but I wanted to get a better understanding of raw material sourcing and what percentage of raw materials would be at risk to the potential tariffs in Canada and Mexico, and then obviously the recent addition of China. So, several months before our huge tariffs on China. But Chuck Magro responds to the question saying, so this is a complicated question. I'll tell you that right up front. The situation is changing almost daily. Isn't that an understatement? And so we have, I'd say, a task team that's working and running models and simulations. Let me start by just saying a couple things up front. This is really a CP issue for us, right? Or crop protection issue because it's a global supply chain. Corn is a little different. It's essentially grown and sold in the same region. Okay. So that's what I was saying, that the seed products are localized and therefore have no tariff risk. So this for us is a crop protection issue. And our two biggest franchise businesses, Enlist and Spinosins, they are manufactured exclusively in the United States. So that sets up Corteva to be basically a net exporter as a company. Now, to give you a view on crop protection, and we'll just use China as an example, thank you. It's about 2% of our cost of goods sold come from China, and about 80% of that 2% we have multi-sourced. So the simulation, the models we've run, and who knows exactly what will eventually happen. But the scenarios that we've run, we think that most of these situations are very manageable. But you're right to call out. We have put none of this in our guide because we just don't have enough confidence in what it may or may not be. Shocking. So the scenarios that are being discussed right now, we think are completely manageable. And the data point I would draw you to for China is that it's about 2% of our cost of goods sold, and 80% of that is multi-sourced. Now, what I did earlier, prior to making this video, was I did some research on the global crop protection supply chain. And what I found is that you have, when it comes to crop protection products, you have these you have inputs to that, or what they refer to as intermediates, and those are kind of the base chemicals that are either used to create other compounds, or used in a more basic sense for the crop protection products. And China actually supplies over roughly, or just slightly over, half of the global supply chain of these crop protection intermediates. And so what that means is that the having a trade war between the United States and China, and potentially China and other nations, United States and other nations, so on and so forth, having that dynamic, I would say, is highly inflationary for crop protection intermediates, um, purely because it causes a huge amount of supply chain disruption. Okay, so if I think it's reasonable to assume, if you have this dislocation with one of the major suppliers of the market, that could potentially take a lot of that supply off the market, or shift where it's going. And at least temporarily, if not in the more intermediate sense, that does create a supply shock and a price shock up, right? So, what I think that means is that this business is, while they don't have direct exposure, or a big amount of direct exposure to China for the crop protection COGS, um, I think that the whole crop protection market is exposed to tariff risks, and that will increase pricing. So whether that's a good or a bad thing just comes down to how much pricing power this company actually has, in terms of crop protection. But we know from looking at their sales here, we see that yes, crop protection is more than half, about 55%, more than half of their sales, whereas seeds are the other piece. So I think under an environment of supply driven inflation, that um, not only does this company have the ability to pass on all of that inflation to customers on the seed portfolio, it's able to pass through some of it on the crop protection. And ultimately, what that ends up meaning is that in a commodity driven inflation environment, that this company uh, ends up being a winner, ends up being a place to hedge some of that macro risk. And it even has some convexity or outsized return potential, relative to the capital risks in that environment. Now, there's no guarantees that that could occur, but I think what we need to do is we need to look at some of the commodities here. This right here is the corn price. Again, we know that corn, being roughly three quarters of 45% of their revenue, meaning that 30% of their revenue is has strong correlation and exposure to the corn price. And while it's a little bit more complex than that, this should give an idea. This is the 10-year chart on corn prices. You see how they were very, very stable. And then here's the supply shock. So corn prices went from $300 a bushel, $300 a whatever unit this is, all the way to over $800. And they have come down, but they have not really come down close to this historical average. And in fact, they've been back on the way up since August. They've been back on the way up since August. I believe coincidentally, this is also when they began lowering interest rates. The Fed, I mean. So we see here that from this August low, that corn, it has increased by 30%. And if we zoom in even further, we see here this is Liberation Day, that corn is up roughly 6% in that time frame. So while that isn't crazy, it does give you an idea of what the tariffs did to corn. Just the threat of the tariffs, just the threat of the tariffs sent corn prices up by 5%. That may be a precursor for what is to happen. Obviously, we know gold has been the story of the year so far, up 39% year to date. Well, I'll tell you what, uh, assets tend to do well in stagflation, gold and other commodities. What about soybeans? The next closest. Well, soybeans are also up 3-4% year to date, but down year over year. So soybeans have outperformed the S&P year to date, but we see the outlook for soybeans again pretty flat, and then we have this huge supply shock here. But again, since the August low, what are we seeing? Soybean prices have broken out. If we want to do technical analysis on this chart, draw a line right here. Draw a line all the way through. Arguably, soybeans have broken out, but that looks pretty bullish. That's a clue. That's a clue of what might be going on. Again, the initial reaction to tariffs was deflationary. I think what we're starting to see is that the inverse might be the case. And of course, it's very common sense to say, well, okay, tariffs raise prices, that's inflation. We know that inflation is a little bit more complicated than that. And supply driven inflation is what we've been used to these last few years. Yeah, corn. They say other oil seeds. I believe what that means is sunflower oil. We see sunflower oil up 51% year over year, up 4% year to date. And rapeseed oil, 9%, 18% year over year. Canola oil up 10% year to date, 10% year over year. We're seeing across the board things are starting to move. It's not a confirmation of a trend, but things are starting to move. And what happens when all of those things move with force? Well, it's reasonable to expect that the earnings of this company might substantially go like this. Now, of course, that's buffered somewhat to the downside by the crop protection cost troubles here. But given that they barely source any of their intermediates from China, and you have other crop protection companies like FMC. FMC actually acknowledged tariff risk from China in their earnings call, I believe. Someone check on that if you can. But in the research I was doing, it did that, but I didn't review the source. It claimed that, so that might be worth a fact check there. But it's in an environment where crop protection prices spike due to supply shortages, and also due to the crazy increase in cost of goods sold. But Corteva doesn't have exposure to those higher cost of goods sold through tariffs. They might actually be able to gain market share and succeed in a challenging environment that's inflationary. So all of that looks really good. And again, the fourth quarter of the year for this company ends up being kind of a weaker quarter, but they're guiding to 290 to 295 a share versus this. So on the high end, we're getting close to a 20 times forward earnings. I believe that that's significantly lower than when we looked at last time. I think it was like 25 or 26 times earnings. So basically, what I'm trying to tell you is that I'm seeing an increased investment case for Corteva in 2025. As of right this second, it's a top idea for me. Again, I think this is a good time for us to refer back to this chart here. Just the price return versus the S&P. We saw how the stock during this period was basically inversely correlated to the S&P 500. So it has defensive properties, but also is a defensive compounder because we see a strong but short track record of dividend growth. I think we have like a 10% compound annual growth rate. They've been raising it a little bit less each year, just 1 cent each time, but still far in excess of inflation. So this company has, as of right now, a pretty low chatter score, like 7 or 8%. 1% dividend yield, and the last couple raises were 6-7%. So it's not necessarily this like strong income compounder, but could very well turn out to be in the long run. So I'm getting more bullish on Corteva for reasons that aren't great. The macro outlook is getting worse, and sadly, that increases, I think, the likelihood that Corteva outperforms. So it is a defensive thing. As usual, it's not financial advice, but I am upgrading Corteva. Previously, I said it was a buy. I think it's been upgraded into the upper echelon, the strong buy category as of now, because again, if we look at the balance sheet, and we probably had the balance sheet in our earnings too. No, we don't. In that quarter, they reported 3.1 billion of cash, and um, current portion of long-term debt, half a billion, less than 2 billion total of debt. And then they plan to pay out a billion in buybacks, and I believe that would be another 500 to 600 million of dividends. So there's more than enough cash in the company to bolster those defensive properties. Here we see $4.53 of cash per share. You'll notice that I haven't done any sort of granular analysis of what I believe earnings will be, or growth, or anything like that. I think it's more of a uh, thinking probabilistically about what might happen to commodities over the next 12 months, over the next 3 quarters, maybe longer. And I think that Corteva is a good kind of a good hedge against that, while still giving you good growth. Another company we covered in this vein, like I mentioned earlier, was Nutrien, but that company is much more cyclical and lower growth at times than this company. So this company has less convexity, but more of a defensive compounder. So for those reasons, I'm upgrading Corteva. I think it's really going. The outlook is good, and I may be wrong, but I change my mind all the time. So, anyways, that's going to conclude our video here. I'm sure there's things that I missed, but comment. Let me know other things here that I can look at that might inform a better analysis of this company, or really any other video. It's been a pleasure to run through this with you, and I hope to do it again soon. I will see you soon. All right. Bye.